All right. Investors, good morning. One of the questions I get asked often is how do I know what my break even price is in a poor man's covered call? Now, a poor man's covered call is basically getting into a position that's cheaper than just buying 100 shares of that stock. So, options contracts, the difference is they expire eventually compared to just owning the shares outright. If you own a stock or own shares of a stock, then technically they never expire unless the company goes bankrupt. The only time that you really pull in or get out of that position is when you choose to, or when you choose to sell off your stock, right? So in a poor man's covered call and selling options and buying options, they come with an expiration date. Every single option contract comes with an expiration date, depending on if it's 7 days, 14 days, 21 days, 30 days, 45, all the way up to 600 and some days I've seen options. Okay, poor man's covered call, you're getting into a position cheaper than if you was to just buy 100 shares of something. The difference in that as well is basically you're buying the option contract at least 2 years, right? 2 years. Let's try to get this thing to work. Poor man's covered call, PMCC, sorry, not PIMP or pimp. It's poor man's covered call is anything over 2 years. Okay, so we're handling a position within that contract for at least 2 years. Now, to find the strike price, if you was to get into a position, and I'm going to show you this example like Boeing. Boeing's cost today is around $170 a share. So we're going to jump into this position, 170. Is 170 per share. But we don't want to buy 100 shares to work this out, which would cost us $17,000. What we want to do is get into this same position or a lower strike price for a little bit less capital. And what I've done over here, let's see when this, moving this over so my camera, 623. Okay, so I've been in this position for over a month now, and it cost me $9,500, and it's at the 110. So I'm theoretically managing an $11,000 for only $9,000. So what happens is when you buy something, you want to sell it for at least break even, or as an investor for more. For this case, what I do, my very first setup is I know that I bought this thing for $9,570 at the 110 strike price. So we have to add these two together, and then divide by 100. Gives us the 106.70. Or actually, you know what? Correction. Let me. I know what I done. I messed up here. 206. Sorry, 206. So our break even is a 206.70 strike price. It's hard to write with this new pen and pad. So why is that? Why is our break even? Well, anytime we buy something, say for instance we're right away buying a car and then we're selling it, we have to be able to figure out what our break even is. When it comes to these contracts, you're getting into a position for less money. But what happens is if for some reason that contract is exercised by the other party you have to find the break even of what to sell the contract for, at least to break even. So we're basically getting into an $11,000 position for only $9,500. Well, we buy this contract, right? We purchase this contract to maintain this type of position. So you have to add that on. So we have to sell no less than at the 206.70. So my very first position that I sold was at the 207.5, and I took in $875. Now within a couple of days we can take a look, and this, I pulled this up and I started this filter to start from the day that I bought it up till today, and it's only Boeing. So to find out all your positions and how to find your newest break even and keep track, you put in your symbol, adjust the date, and literally these filled orders is all of my positions or entries and exits that I have managed so far. So on 6/23 I sold this for $870, and then 6/24 right at 93 I bought it for almost actually I did for a $200 profit, and then I sold it again on 24, and then that same day I bought it, got to buy it back again, sold it again on the same day, waited a couple days on 7/2 and bought it back again for profit, and so on and so on. So these reds are shorting or selling the contract for a credit, and then in the green I'm buying that position back for a lower, in hopes, lower amount to make a profit. Because in this type of scenario, or in the stock market world, you're actually allowed to sell something and then be able to buy another contract for cheaper, if that makes sense, for a profit. So what we're doing is we're covered here in the long. So I get to sell a contract against it and then be able to buy that same contract for cheaper, which makes it a profit. So to keep track of this, all you would do is you would take your calculator, or you can write it down on paper, whatever you want to do. And I'm going to do this. Let me move this over for you. So I bought it for $9,070, and then we're going to subtract $875, and then plus $750, subtract $1,000, plus $810, subtract $1,020, plus $1,015, and so on and so on. Then I bought it back for $800, and then I sold a contract for $803, and then I bought it back for $700. Bought it back for $465. Which gives us $7,996. So out of the $9,570 that I spent, I now have lessened my break even, because overall this strategy gives me 2 years, 530 some days, a little over 2 years. And basically I want to pay this thing off, and then I'm in my position for free, and everything else is profit. So unlike real estate, or similar to real estate, let's say that you're taking a down payment to get into a bigger debt, right? The only difference is these are a little bit less debt with the same amount of capital that it takes. So for the down payment on, say, a $150,000 house, the 10% might cost you $15,000 to manage a $150,000 house. What you do with that is obviously the rent, tenants, taxes, and toilets. By the time you manage all of that and then pay your mortgage, is it really worth the real estate portion when you're renting out houses? A lot of people do the fix and flips, but in this case, the stock options world is similar to renting your stock out. Hence why I have the book treat your stocks like real estate. So we're basically wanting to make money off of the 9,000 and do this on and on and on for the next 2 years and make money and try to get this thing down as close, if not zero, as soon as possible. The quicker the better, because as Boeing stays above my 110 that I got into this position for, now I can exercise or the right to buy Boeing at 110, and I've paid this thing off. So my portfolio is down 9,500, but now I'm basically lessening that negative gap or that debt by paying this thing off. So we would take the 110, which is so we're in the 110 strike price. Remember, everything's one contract is by 100, so that's where I get, you have to times this by 100. So the 110 strike price is really $11,000. Now we want to add what our remaining balance is, the 7,996. So we want to add this to the 1,000 or 11,000. Divided by 100, and this is going to give us the now break-even strike price, the 189.96. So let's just say, I mean, we can do it to the T, 189.96, but the options strike prices are not going to be that. We're just going to say 190. So we're looking at anything at least a 190. So we're going to go into Boeing. And we're going to try to sell anywhere. Now, as you can see, I do have a position on. But let's take, for example, the 34-day. The 190 is going to give us a $515 return. And I say this because the 190, if we sell the 190 and it breaks 190, by expiration, we have to give up our shares at 110, sell those, and then sell them for the one at the 190 strike price. So that's where you get the difference, and it has to at least be break even. Because, for example, if we do the 110, right, the system will give us 100 shares at 110, which is 1,000, and then it's going to get called away to someone else at the 190, which is 19,000. So the difference between this and this has to be at or less than the 79.96, which gives us the break even there. So I hope that helps to explain how you get your break evens. The system will give you the break even also when you go and buy your poor man's covered call. It's going to give you right away in the order menu what your break even is, and that's simply how they come up with it, is the difference in the strike prices. The strike price that you at least have to go out to when you're selling a covered call to cover the difference if the stock gets called away from you. So we're getting around 570 to 515, whichever one fills. I always like to go for the ask side because that's always the more. So let's do this. 570 divided by 7,996 now is a 7% return in 34 days. Our overvalue, which is our value that we originally paid for, the 950, right? If we take the 570 and divide it by the 9570, we're getting a 6% return. Wow, 6% every single month on the original 9,500. Now, as we break this thing down and we make more and more money, we can literally take the new cost, right, and divide it by whatever we're making. And you can look at your ROI that way too. I always just keep it whatever I originally paid for because I don't care until I get this thing paid off anyways, and keep it at this. But if you want to float your numbers a little bit, make them look better, whatever you guys want to do, or at least the psychological behind it, if you're getting 570 on your now 79.96, I did that wrong, sorry. 570 divided by 7,996, you're getting a 7% return. So as you can see, It is a pretty good strategy, and when you're long and long term, is ultimately I want to be able to pay this thing off and then Boeing take off, or I want this thing to just go ahead and break through my original 190 and it gets called away from me, and then I go back and get into this position again, maybe farther out, 670 days, and I'm going to start looking at which strike price that I think that the stock probably won't ever go down to, and that's affordable. Because here's another tip that I always give you guys: when you're getting into a poor man's covered call, never purchase the contract more for the strike that if you was just to theoretically buy that thing at 100 shares. Because if I'm looking at this 95 strike price, it's costing us $8,600. Well, at the 95 strike price, I could just buy 100 shares worth for $9,500. So I really don't like that number. If you go up a little bit, the 135 strike price, if you was to buy 100 shares at the 135, that's $13,500, right? And now you're only getting in that position for 50% discount at $6,000 or $6,200 or $6,665 here. So then you would add the $6,065 to the $13,005, divide by 100, and that would be your break even. If I go in here into the buy button, you can see what this thing is the 201. It's giving me the 201 strike price. Okay? So that means I wouldn't want to sell anything. I always like to go 35 to 45 days out, because remember that yield, that curve of theta kicks in. So I wouldn't want to go anything less than 201. It's giving me 200 and 205. So for $6,000, I'm making $300, $282. So we do 282 divided by just 6,200 gives us a 4.5% return for our money. Now that's pretty good, because there's no tenants, there's no taxes. There are taxes, capital gains, and there's no expenses, and I don't have to pay a mortgage bill. The only thing I'm doing is trading contracts. I purchase the contract and then I start selling contracts against it. So that's how you manage and basically keep track of your poor man's covered call positions, is go into the account statement right here, and then from the day that you get into this thing, right? I have a couple losses here right now. This is in my 5K fund, but I want to take note. I bumped this thing up to about 15,000, and now it's only down $2,000 because Boeing, it did take a loss. I bought it at the 110, and at the time it was like 190. So we've lost 20 points, but I'm scalping. As you can see, I'm still making profit here. In the long run, I hope Boeing eventually goes back up. I'm not too worried about it. It's one of those stocks. It is backed by the government. You and I both know they always bail them out. And then General Electric here, I haven't sold a covered call because I think General Electric, I see in its stock chart that it should be going up soon, so I don't really want to lose that position. I want to hang on to it. The same thing for space. Big things that Richard Branson is doing. He came out with a new commercial. I don't know if you guys have seen it, where he's actually showing what this internal of the spaceship's going to look like for civilian and commercial flights up into space. So I think this is going to be a long-term hold too. And then Walmart, obviously, it's eating up a little bit, $27. I have sold other covered calls against it to make that loss up. So this is pretty much my 5K portfolio, and how I've managed it to build it is literally just by poor man's covered calls. Go in your account statement, look up your position by, so I want to see when I bought Boeing. I'd right click, scroll down to view trades, and I bought this thing at 6:23 at 9:54 p.m. It tells me my price, it tells me how much it cost and what it is now. Go over to account statement and do your filter, and then with Boeing, and then you just do the math like I showed you. You can do this in spreadsheet, but you literally just put in your original cost and then start subtracting, then adding, subtracting, then adding, and then add that up to your 110 or your strike price and divide by 100. I hope that formula isn't too hard. But anyways, that's pretty much it for tracking down your poor man's covered calls, keeping track of your profits, how to set up those strategies and what to look for when determining your break-even prices, and the tip of 35 to 45 days expiration out, because you're going to find that theta curve really takes off and you can be able to buy back your contracts a lot cheaper within that curve, because that's really when the time decay takes off for those who are buying options. So as always, happy trading, and until then, I'll see you in the next video.